Hey, do you remember the days when you could save money at the bank and it was a good thing? I do. I remember having a savings account that used to earn 5%, but those were the glory days. Those days are gone. As of today, the Federal Reserve just lowered rates again for the third time this year. They cannot figure out how to increase rates without the stock market collapsing. And so what happens to our money if we choose to use a bank and interest rates stay low? That's what I want to go through today. I've been working with a younger client of mine who has been saving diligently at the bank. He's disciplined. He makes pretty good money for his age, but he's very risk averse. Like most millennials, he does not want to go into the stock market. And real estate is at such a high level right now, it just doesn't make sense unless you have access to the best deals. And so this particular client that I'm working with wants to save $7,500 a year and wanted me to show him what it would be like 30 years from now with a bank at the rates that they have right now. And he also wanted to see if I was to use the strategy from my best-selling book, Taming Wall Street, what that would look like. And so I've gone ahead and drawn this out, and you're going to be able to tell very quickly that over the long haul, a bank is not your friend. And there's many reasons why they're not your friend, but for this video, I just want to show apples to apples, same amount of money, same amount of time, totally different outcome. So when you earn money with the bank, you're not taxed on the principal that you put in, but you are taxed on the gain, and so that has to be taken into account. Where with a cash value life insurance plan, you don't pay tax on the growth, you don't pay tax to use it, and when you die, that money passes to your beneficiary completely tax-free as well. So one of the last big tax advantages in the tax code. Well, I want to point something out. And I've shown this, I'll tell you, it takes between 6 to 8 years to break even on a plan, but that's okay because you have death benefit all along the way. But after 1 year of putting $7,500 in, his account would have been up $7,506, where in year one, he has $4,144, okay? The difference is, he can take this money out and keep earning interest as if it were still there, where if he takes money out of this account, he immediately stops earning interest. But he also has $771,000 in death benefit if something were to happen to him. So a good question to ask yourself is, if something happens to me, do I want to leave $7,506 or do I want to leave $771,000? It's a big difference, right? So now let's go out 5 years. So now some time has gone by, $37,584 compounding interest, right? With this, I'm still not to break even. So I'm $31,538, and my death benefit's gone up by about $1,000. By the time we get to year 10, this is where things really start to develop. You can see after putting $75,000 away for a decade, he's only up $310. That's just not a lot. Where with my plan, he's at $85,583. He's up $10,583, and his death benefit's up a couple $1,000. So he's doing really well. Again, he has access to this money and can continue to earn interest as if it were never gone, where if he touches this money, he immediately stops earning interest. So this is a pivotal moment, right? The break even on this one was actually around the 7th year, but just to keep it simple, let's look at the 10 years, okay? So let's keep going. My plan is now starting to significantly outproduce working with the bank. Now check this out, the death benefit's growing too. So let's say in year 20 he dies. He's passing a nice chunk of money that will still have to be taxed, or he could pass $1.1 million and have it not be taxed. That's a major difference. But let's just keep going, right? Let's go out to year 30, which is what the client asked for. At year 30, $227,635 versus $550,055. So during his life, he's got access to $500,000, and if he dies, his family or beneficiary is going to receive $1.6 million completely tax-free. Now, if this is me, I mean, this is what I want. I want living benefits. I want access to my money. I never want to pay tax, and I never want to lose. And if I do die, that's the ultimate loss. I want to win even in death. I want my family to win. So it's real clear that trusting a bank to grow your money is a bad idea. It may be safe, but it's safely losing buying power. And so, although this takes a few years, you've got that death benefit, which is the ultimate safety net. But then once you get past that break even, this thing just, it picks up a tremendous clip and starts moving much, much faster. You guys, what rate are you earning at the bank? Put it in the comment. I mean, this is crazy how low banks are paying right now. And so you have these incredible institutions that used to be good for saving money that are now not helping the American saver or the American citizen. And so what are they doing? They're shifting over into the stock market. They're taking on tremendous amounts of risk because they know that they need to beat inflation, right? But neither of those strategies protect you in death. Neither of them protect you in your taxes. So this is just, it's huge. And I wanted you to see an apples to apples comparison. Hey, make sure to subscribe. Hit that red button right now and make sure that you hit the bell so that you're informed when a future video pops up. Hey, my name is Stephen Gardner. I'm the author of Taming Wall Street. If you have anything that I can help with, please reach out to me at Stephen with a PH at yourbridgeplan.com. Otherwise, thanks for checking out today's video.